Usually you buy things during the holiday and not sell them, but I have sold 3 of my holdings. I'm doing this as part of my strategy to consolidate my portfolio more and to hopefully create a better growth path. Of course, consolidation of a portfolio comes at a cost, being less diverse, aka more risky, but I think I was over diversified and I will explain that as that dilutes your growth potential. The idea with making your portfolio more concentrated is to increase the potential for growth with a small handful of quality holdings. Now, I've seen portfolios with hundreds of stocks and others with as little as one. So a wide range, but I want to fall in between about 10 to 15 holdings. I think this is a great consolidated portfolio that gives a good balance of growth and enough diversity for safety. Now, before I sold these 3 holdings, I had a total of 17 holdings. So now I have 15. I have 3 more I want to sell and 2 more potential sells. This would bring me down to 10 holdings total if I did that. For now though, I am at the top of my range at 15. So let me reveal my first sell, and that is an ETF, and it's Foodie. This is a Fidelity Utilities ETF. Why I sold this is I had 5 ETFs in my portfolio and think that is personally way too many. I think 1 to 2 ETFs is enough. Now remember, an ETF can have hundreds to thousands of holdings in one fund. So with Foodie, they had a total of 69 holdings, and the top 10 made up about 52% of this fund's profile. If we do look at the top 10 companies, we see some well-known names. If you're familiar with utilities, NextEra Energy is probably the most popular, but here's the list of their top 10, and this fund had an expense ratio of 0.084%. So a very low expense ratio, but an expense ratio that hits the investment regardless. Now, over the last 5 years, their stock has performed pretty poorly. It's only grown 9.25%, so that's 1.85% growth per year. It also pays a dividend yield of about 3.42%, so pretty healthy, but does not even closely make up to the lack of growth in the stock. For comparison, SCHD has grown 48.79% over the last 5 years and pays a 3.76% yield. So Foodie has been a massive underperformer, but that's somewhat expected from the utility sector. It's a more steady but slow growing industry. So why did I buy Foodie? Well, originally my strategy was to hold 1 ETF per sector of the stock market, and I did at one point. I had an ETF for every sector. I know that's crazy, right? Now my thought at the time was to be extremely diversified and safe, but I slowly realized that that type of strategy will only cap my growth potential and keep me in this ultra diluted and over diversified portfolio. I sold out of most of them over a year ago. I kept Foodie as I had no individual stock in the utility sector, but I asked myself, why do I have to have a holding in each sector? This is just a rule I came up with for myself, and it's okay to not have a holding in each sector. The utility sector as a whole usually underperforms, so why would I want that in my portfolio? I had to grow comfortable with the idea of not feeling like I had to do this. So Foodie was a measly 1 to 2% allocation of my portfolio and contributed to the dilution of my portfolio. So I had no plans of making this a significant holding, so I decided to sell. In the green, by the way, I made about a 6% gain, and I will utilize that money somewhere I feel is much better. Now the next holding I sold is another ETF, and that is FMAT. This is a Fidelity Materials ETF. I sold for the same reason as Foodie. FMAT has 122 companies in this fund, and about the similar profile with 52% being in the top 10. Here are the top 10 companies. We see companies like Sherwin-Williams, Ecolab, so on and so forth. Some pretty good quality companies actually. Its expense ratio was the same at a 0.084%, and over the last 5 years, it was actually a pretty good performer at a 58.45% growth. That's about 11.69% annually. It pays a dividend yield of 1.8%. So again, comparing to SCHD that grew 48.79% over the last 5 years and pays a 3.76% yield, FMAT has outperformed about 10% stock price wise, but SCHD does pay a much larger yield. So for me, SCHD was just better anyways, and I like the diversity more of SCHD across sectors. So FMAT again is a holding that over diversified my portfolio, was also a measly 1 to 2% allocation of my portfolio. I had no plans on making this a significant holding, so I decided to sell. and I did make also about a 6% gain with my sell. I do think that FMAT's solid performance over the last 5 years might lead it to underperform over the next 5 years. I don't know if it can replicate that. So it's not a bad fund, and one that I decided to sell and will utilize the money somewhere I feel is better. Now onto the stock I sold. This is not a fund, this is a stock, and I think this one will make you scratch your head just a little bit, but hear me out first. This is a quality company I sold, but I had one main thing I felt it lacked that ultimately made me sell, amongst other small reasons. And I think I can put that money to work in a better investment. So the stock that I ended up selling was Home Depot. Now, Home Depot was a much more significant holding in my portfolio at just under 5% allocation. And let me start off by saying, this is a quality company. It's one I feel can outperform long term. So by me selling, I am in no way saying it's a bad investment. So let me share why I sold. First, I'm going to share what I consider my small reasons, and then I will share the one big reason why I sold. So small reason number one, I hold SCHD at a high allocation in my portfolio, and Home Depot often is in the top 10 of this fund. So I felt I had overlap, and by keeping my SCHD holding, it allows me that exposure to Home Depot anyways. So technically, I'm still invested in Home Depot through SCHD. That was my small reason number one. My small reason number two why I sold is the housing market and the economy. With high interest rates and a tightening economy, people are and will continue to pull back on high dollar items and will probably put off home improvement projects for a few years. The lack of affordability with high home purchase prices will create a few years of slower growth in my opinion. I know many people that cannot sell a home right now, which is crazy because previously we just had about 3 years of homes selling like hotcakes. So this directly impacts Home Depot. In their last earnings actually, it showed that sales declined 3% year over year, and their full year guidance indicated caution ahead. So I think Home Depot will have some challenges, and I'm getting ahead of that by selling now and allocating my funds elsewhere that I think will have the opposite trend over the next couple of years, and that's growth. Now, I've said this before, I do think Home Depot will do better than analysts are expecting, but I see a higher chance of underperformance versus the S&P 500 over the next 1 to 5 years due to the housing market and the economy. This was my second small reason why I sold. Now, my small reason number three is high debt. Home Depot carries a higher debt load than I am comfortable with. Now, they do utilize that debt wisely, but at the end of the day, debt is something I don't want my companies having a high percentage worth of. So we can see here that their long-term debt over the years just goes up, up, and up. And if we compare the long-term debt to the current assets of Home Depot, you'll see long-term debt is always higher. And their total assets versus total liabilities, I don't have the chart here right now, but they're often neck and neck, and I'd rather have a company where their total assets are much higher than their total liabilities. If we look at their debt profile, we will see here that they have a total debt to assets of 65.01%. In comparison, Microsoft's total debt to assets is 21%, Home Depot's is 65%. So they trend higher on their debt levels compared to the special retail average out there in the market. And then you'll see their dividend payout ratios of 52.25%. We're going to talk more dividend in just a second. So I have always said this, debt usually limits companies' potential, and I just rather invest in a company with a lower debt profile, even though I feel Home Depot is responsible with its debt. So that's my small reason number three why I sold, and it's debt. Now, small reason number four, I simply wanted to consolidate and concentrate my portfolio more, and this was a quality company that I felt offered the least growth out of my other quality companies, so it was the one that was on the chopping block, and I decided to sell. That's simple reason number four. Now on to the big reason why I sold Home Depot. I've shown this a few times, but this is a quality checklist I go off of to buy quality stocks. The more items that get checked off, the higher quality the holding. There was one item on this list I felt Home Depot lacked compared to my other holdings, and that was a strong, dependable recurring revenue source, such as a sticky subscription. You look at Costco, it is a retailer with a great recurring revenue model, and that is through memberships. They have been very successful at these memberships, and they're very sticky. And Costco is highly sought out by consumers as you can buy bulk and save a pretty good amount of money. I go to Costco a few times a month, and I know many that do the same. With Home Depot, I might go 3 to 5 times a year, but because they do not have a membership that offers a good cost savings benefit compared to rivals, I also go to Lowe's or Ace Hardware. I can easily transfer between these home improvement stores, whereas Costco is the only wholesale retailer I go to. You see the difference here? So I think weakness in Home Depot with repeat customers, recurring revenue, customer dependency, and ecosystem compared to others in the stock market led me to sell. I know I would not want to give up my Costco membership to shop somewhere else, and I know many others that love Costco and would not give up theirs. But with Home Depot, there is nothing that makes me loyal to the company like I am Costco. So this is the main reason I sold. I think other companies offer a better growth path as they fulfill this important cash generating investing quality trait that Home Depot that just doesn't, they're not as strong in as other companies, and they kind of lack in that area. So now, again, Home Depot is a quality investment, and I am not saying if you hold it, you should sell. I think it will deliver solid results for the long-term investor. Over the last 5 years, it's grown an impressive 89.34% in the stock market. That's 17.87% growth annually. And regarding that dividend, they have a yield of 2.56%, so pretty healthy, but that growth is what really matters. And over the last year, they've grown that dividend 10%. Over the last 5 years, 15.2%. Now their payout ratio is 52.25%. That's an okay payout ratio. Anything below 75% is safe. Anything below 50% to me is the best situation, but they're just above that, so not bad. So again, I sold for the reasons I mentioned, but in no way am I saying this is a bad stock. It just so happened that my strategy called for it due to my want to consolidate my portfolio more and the lack of strong recurring revenue that I feel Home Depot is weaker in than others. So if we look at the quality checklist again, we'll see they check off solid financials, they have a good management team, positive brand recognition, and a good moat. But their valuation right now I think is a little high, and where I put the X was that products and services, just that lack of that membership, subscription, that customer dependency, because people can easily just go to Lowe's or Ace Hardware, and that ecosystem I think is a little bit weaker compared to other companies in my portfolio. Speaking of my portfolio, this is something I share with every video. If you like this transparency, this honesty, this is the channel for you. Be sure to subscribe. Right now, my portfolio is in the green 15.77%, and something great has happened. My yield on cost is higher than my dividend yield at market value. So what I bought my stocks at, I'm getting a higher yield than what people can buy it now at market value. So yes, my portfolio now is looking more naked than ever, and it's gonna get even more naked and consolidated, but this is what I want. This is what I feel will drive growth. So stay tuned because there will be more changes, and I will share them all with you. So I welcome your thoughts to this. If you feel I am moving in the wrong direction, let me know why. I'd love to hear your take, or if you agree and see what my goal is and why I cut Home Depot out. And it's not for an issue of a bad investment, but rather to strengthen my opportunity for outperformance. Thank you all for joining me today. I hope you have a fantastic day, weekend, week, whatever's upcoming for you. And we'll see you very soon on my channel. Have a great day.